The financial industry has effectively weaponized the concept of free. When a transaction carries no visible cost, the economic friction that historically governed market behavior vanishes. This absence of friction is not a void, but a highly engineered form of operational leverage, designed to maximize human behavior rather than optimize portfolio returns. The modern investor navigates an ecosystem where the absence of a commission slip obscures a much deeper, more complex monetization engine running quietly in the background. The retail investing landscape transformed rapidly when established brokerages capitulated to the zero-commission model, following the lead of aggressive Silicon Valley disruptors. This shift was universally heralded as the democratization of finance, tearing down the walled gardens of Wall Street. However, financial infrastructure requires massive capital to operate, maintain, and secure. If the revenue does not originate from a transparent upfront fee, the capital extraction simply migrates to a less visible juncture in the trade lifecycle. The core engine replacing the traditional commission is payment for order flow, widely known in regulatory circles as PFOF. When an individual taps a screen to purchase a share of stock, that order does not travel directly to a public exchange like the NASDAQ or the New York Stock Exchange. Instead, the trading app acts as an aggregator, bundling thousands of retail orders and auctioning the exclusive right to execute them to specialized financial institutions. These institutions, known as market makers, are the silent counterparties to the modern retail boom. They pay the trading apps hundreds of millions of dollars annually for the privilege of handling this retail order flow. The market maker is not paying for the data out of charity. They are purchasing the rights to a highly predictable, generally uninformed stream of volume that allows them to extract microscopic profits from the bid-ask spread on every single transaction. The bid-ask spread represents the fundamental difference between the highest price a buyer is willing to pay and the lowest price a seller will accept. In traditional environments, market makers earn their keep by bridging this gap, providing liquidity to ensure markets function smoothly. But when they purchase exclusive rights to retail flow, they gain an informational advantage. They can execute a retail buy order at a fraction of a cent higher than the broader market rate, or a sell order a fraction of a cent lower. These fractional pennies appear entirely inconsequential to the individual investor executing a small trade on a Tuesday afternoon. However, when multiplied across billions of shares and millions of daily active users, those fractions aggregate into staggering institutional profits. The zero-commission trade is subsidized by the very spread the investor pays, resulting in a slightly inferior execution price. The cost has not been eliminated from the system. It has merely been atomized and embedded into the asset price itself. For the buy-and-hold investor executing a few trades a year to build a long-term retirement portfolio, this embedded cost remains relatively benign. The long-term compounding of a well-selected asset generally overwhelms the microscopic friction of a widened spread. But the architecture of modern trading apps is rarely optimized for the passive, decades-long holding of index funds. The platforms are inherently designed to stimulate continuous engagement, transforming the smartphone into a portal of constant financial action. This brings us to the concept of behavioral leverage, where the design of an interface amplifies the inherent psychological biases of the user. Gamification techniques, once the exclusive domain of mobile gaming and social media, have been deeply integrated into financial platforms. Bright colors, celebratory animations, push notifications regarding daily market movers, and seamless one-tap interfaces all serve a singular structural purpose. They reduce the cognitive friction required to make a financial decision. When the barrier to entry is lowered to a mere swipe, the velocity of trading naturally accelerates. Investors are nudged toward treating equities and complex derivatives as entertainment rather than ownership stakes in real businesses. This accelerated trading frequency is the exact metric that drives the PFOF revenue model. The more an investor trades, the more order flow the app can sell to the market maker, and the more the investor bleeds capital through the hidden tax of the bid-ask spread. The proliferation of zero-cost options trading represents the most acute manifestation of this systemic risk. Options contracts inherently carry significant financial leverage, allowing users to control large blocks of underlying stock for a relatively small premium. While these instruments are vital for sophisticated hedging strategies, their presentation on retail apps often strips away the necessary context regarding theta decay, implied volatility, and the asymmetric risk of total capital loss. Market makers are particularly aggressive in their bidding for retail options order flow, often paying significantly higher premiums to the brokerages than they do for standard equity trades. The spreads on options contracts are naturally wider and more complex to navigate, providing a much larger margin for the executing institution to capture. Consequently, the retail investor actively trading short-term options is generating massive revenue for the platform, while simultaneously exposing their own portfolio to amplified volatility. Historically, the high cost of a broker commission served as a natural speed bump for the average investor. If a trade cost $10 to execute, the investor had to be reasonably confident that the underlying asset would appreciate by at least $20 just to break even on the round trip. That friction enforced a degree of strategic deliberation. It inherently discouraged the rapid-fire day trading of small positions, forcing capital allocation to be a calculated, long-term endeavor. The removal of that historical speed bump fundamentally altered market microstructure. Without a visible penalty for entering and exiting positions, the average holding period for retail assets plummeted. This hyperactive environment creates a feedback loop where volatility begets more trading, and more trading generates more revenue for the hidden infrastructure. The democratization of access inadvertently became the democratization of rapid capital depletion for those caught in the engagement loop. On a macroeconomic scale, this retail order flow has fundamentally reshaped the power dynamics of global liquidity. A concentrated handful of massive market-making firms now process a staggering percentage of total daily volume, effectively internalizing trades before they ever reach a public exchange. This concentration of execution power raises critical questions regarding market transparency and the true nature of price discovery during periods of extreme economic stress. When order flow is heavily internalized, the public exchanges see less volume, which can theoretically widen the spreads for institutional investors and pension funds operating on the lit markets. The entire financial ecosystem becomes interconnected in ways that are not immediately apparent to the individual tapping a buy button on their commute. The operational leverage achieved by the platforms creates a systemic dependency on continuous retail participation to feed the market-making engines. Regulatory bodies, primarily the SEC, have continuously scrutinized this interconnected web of incentives. Proposals to mandate order-by-order competition or to outright ban payment for order flow have been fiercely debated within financial policy circles. The core regulatory concern is whether brokers can truly fulfill their legal obligation of best execution when their primary revenue stream dictates routing orders to the highest internal bidder rather than the venue offering the absolute best price. Defenders of the current model argue that PFOF has undeniably lowered the barrier to entry, allowing individuals with minimal capital to participate in wealth creation. They point to price improvement metrics, suggesting that market makers often execute retail trades at prices slightly better than the national best bid and offer. However, these metrics are highly complex and often fail to capture the holistic cost of the behavioral shifts induced by the zero-commission environment. Navigating this landscape requires a sophisticated understanding of strategic leverage and personal capital allocation. The modern investor must recognize that if the product is free, the user behavior is the actual product being monetized. Acknowledging this reality is the first step in reclaiming agency over a portfolio. The tools provided by these platforms are exceptionally powerful, but they must be wielded with strict, self-imposed discipline rather than reactive impulse. True wealth generation relies on the compounding of capital over extended periods, driven by macroeconomic growth and corporate earnings, not by attempting to scalp fractional movements in a heavily intermediated market. Investors must deliberately introduce their own cognitive friction back into the process. This means evaluating the fundamental thesis of every asset purchase, completely decoupled from the gamified notifications and trending ticker symbols engineered to provoke immediate action. Evaluating the true cost of trading requires looking beyond the absent commission fee. It demands an accounting of the widened bid-ask spread, the potential tax implications of increased turnover, and the opportunity cost of holding cash in low-yielding sweep accounts often utilized by these platforms. Many free apps generate substantial secondary revenue by paying zero or minimal interest on uninvested customer cash, while lending those same funds out at prevailing macroeconomic interest rates. This interest rate arbitrage represents another hidden layer of the zero-cost model. When inflation is elevated and central bank rates are high, the opportunity cost of leaving cash uninvested in a non-yielding platform account becomes a significant drag on overall portfolio performance. The platforms leverage the user inertia, capturing the yield that in a more transparent environment would rightfully belong to the depositor. Furthermore, the risk of catastrophic loss is amplified when margin trading is introduced into frictionless environments. Margin allows an investor to borrow funds against their existing portfolio to increase their purchasing power, introducing direct financial leverage. When combined with the behavioral nudges of a gamified app, inexperienced users can easily overextend themselves, facing devastating margin calls during sudden market downturns that wipe out their underlying equity entirely. The architecture of these platforms often obscures the severity of margin risk, presenting borrowing power as a seamless extension of the user capital. But leverage is entirely agnostic. It amplifies gains during bull markets with the exact same mathematical ruthlessness that it accelerates losses during a correction. The hidden cost here is not just financial, but the potential for irreversible damage to an individual's long-term economic stability. Ultimately, the evolution of retail trading applications is a masterclass in the redirection of friction. The financial industry did not eliminate the cost of participating in the capital markets. It merely redesigned the extraction mechanism to be invisible, continuous, and highly dependent on human psychology. The operational leverage of bundling millions of small trades has created a highly efficient monetization engine that thrives on volume and velocity above all else. The informed investor must operate with a clear-eyed understanding of these underlying mechanics. By recognizing the subtle tax of the bid-ask spread, resisting the psychological pull of gamified interfaces, and prioritizing long-term compounding over rapid turnover, individuals can utilize these zero-commission platforms to their actual advantage. The true democratization of finance does not come from a free app on a smartphone, but from the disciplined, strategic application of financial knowledge in an increasingly complex world.